Welcome to StokTok's deep dive into AT&T Inc. AT&T is one of the largest telecommunications companies in the United States, providing wireless, broadband, and video services to millions of customers. At the time of recording, AT&T shares are trading at 26.2. Over the trailing 52 weeks, the stock has ranged from a high of 29.79 down to a low of 22.95. The Relative Strength Index, or RSI, stands at 43, indicating neutral momentum. The 50-day moving average sits at 27.5, while the 200-day moving average is at 26.2, suggesting the stock is consolidating near longer-term support levels. Let's work through the fundamentals, scene by scene. Starting with a quick business overview. AT&T generates revenue through wireless subscriptions, broadband services, and video offerings to both consumer and enterprise customers. The company's competitive moat rests on scale, established customer relationships, and significant capital infrastructure. The billions invested in networks create high barriers to entry. The StokTok score is 47 out of 100, signaling caution. Breaking down the 5 dimensions. Valuation scores 17 out of 20, suggesting attractive pricing relative to earnings. Financial health scores only 8 out of 20, a material concern. Profitability is rated 13 out of 20, solid but not exceptional. Growth is rated just 1 out of 20, reflecting the mature, slow-growth nature of the telecommunications sector. Smart money scores 8 out of 20, indicating institutional appetite is mixed. Now, valuation. The question every investor has to answer: are you paying the right price? AT&T trades at a price-to-earnings multiple of 8.69 times trailing 12-month earnings. This is materially below the broader market average, suggesting the market is pricing in either slower growth or higher risk. The PEG ratio, which divides the PE multiple by expected growth, stands at 0.87. A PEG below 1 typically indicates valuation may be attractive relative to growth expectations, though in this case, growth expectations are extremely modest. The EV to EBITDA multiple, which compares enterprise value to earnings before interest, taxes, depreciation, and amortization, is 6.21 times. This is also below sector median, reinforcing that AT&T appears inexpensively valued on conventional metrics. From our view, AT&T's competitive moat, its scale, brand recognition, and installed network base, provides pricing power and customer switching costs, though the moat is gradually eroding as wireless commoditizes. The GuruFocus value at the time of recording stands at 21.59, compared to the current price of 26.51, implying a negative margin of safety of 22.79%. This means the market is pricing AT&T at a premium to the intrinsic value estimated by GuruFocus models, which warrants caution. Wall Street analysts, at the time of recording, have a consensus mean price target of 30, with targets ranging from a low of 25 to a high of 36. This suggests upside to current levels from the analyst consensus view, though we must note that Wall Street consensus often underestimates structural headwinds in mature telecom. The next earnings report is due July 22, 2026, with the street expecting earnings per share of approximately 0.59. Market sentiment around AT&T, as of the creation of this video, leans neutral. No material news flow is driving sentiment in either direction. In valuation, the setup looks interesting to us. The stock trades cheaply on earnings, yet trades at a premium to intrinsic value models, suggesting the market is fairly balanced between valuation attraction and structural weakness. Moving to financial strength, how solid is the foundation? The Piotroski F-score is 7 out of 9. This 9-point checklist evaluates profitability quality, leverage trends, liquidity, and operational efficiency. A score of 7 indicates financial health is adequate but shows some emerging stress signals. The Altman Z score, a multi-factor bankruptcy risk model, stands at 0.98. This is below the danger threshold of 1.80, suggesting material financial distress risk. This is a red flag that demands attention. Turning to the balance sheet itself, AT&T's cash-to-debt ratio is 0.12. This is concerning. The company holds only 12 cents of cash for every dollar of debt obligations. This reflects heavy leverage. The interest coverage ratio, which measures how many times operating earnings can cover interest expenses, is 3.67 times. This is adequate but not comfortable. A healthy utility or telecom typically maintains coverage above 5 times. Below 4 times raises questions about the company's ability to service debt in an economic downturn. The current ratio, measuring short-term liquid assets against short-term liabilities, is 0.91. A healthy current ratio sits at or above 1.0, meaning AT&T has less than $1 of liquid assets for every dollar of near-term obligations. Finally, debt to equity stands at 1.4. This means AT&T carries $1.4 of debt for every dollar of shareholder equity. For a mature, stable utility or telecom, this is on the high end of acceptable, but it limits financial flexibility and dividend growth capacity. The verdict on financial strength is clear. The balance sheet is leveraged, the liquidity position is tight, and bankruptcy risk models show distress signals. This is a structural constraint on the company's ability to invest in growth or return capital to shareholders without refinancing pressure. Next up, profitability. Is this business actually making money efficiently? Return on invested capital, or return on invested capital, is 5.7%. Return on invested capital measures how much profit the company generates for every dollar of capital deployed. 5.7% is below the cost of capital in a normalized interest rate environment, which in our view suggests AT&T is not creating economic value at scale. It is maintaining, not growing. The gross margin, revenue minus cost of goods sold, expressed as a percentage, is 59.55%. This reflects the company's pricing power in its core services and the relatively high-margin nature of wireless and broadband. The operating margin, which adds back operating expenses like salaries and depreciation, is 19.90%. This is solid for a capital-intensive telecom, showing reasonable cost discipline. The net profit margin, the percentage of revenue that flows through to the bottom line, is 17.47%. This is healthy and shows that AT&T converts revenue into earnings efficiently after all expenses and taxes. The free cash flow margin, measuring operating cash generation minus capital expenditures as a percentage of revenue, is 15.47%. This is the truest measure of cash generation available to service debt, pay dividends, and reinvest. At 15.47%, AT&T is converting roughly $1.50 of every $10 of revenue into available cash. This is the primary reason the company remains investment grade and can sustain its dividend. The verdict on profitability is mixed. AT&T is a profitable business with healthy margins, but return on invested capital below the cost of capital suggests limited organic growth opportunity. The company is a cash cow that harvests earnings rather than reinvests for expansion. Onto growth. Is this business expanding, and at what rate? Revenue growth over the trailing 3 years is 1.3% annually. This is minimal. Over the past 5 years, revenue has actually declined at negative 1.6% annually. This reflects the secular headwinds facing traditional telecom. Wireless penetration is mature, broadband is saturated in many markets, and video is declining as customers migrate to streaming services. Book value growth over the trailing 3 years is 4.7%, suggesting management is slowly growing shareholder equity through retained earnings. The dividend yield sits at 4.19%. This is high relative to broader equity market averages and reflects AT&T's positioning as a yield play rather than a growth investment. From our view, the dividend is well supported by free cash flow, but the yield also signals that the market expects minimal capital appreciation. The dividend is unlikely to grow meaningfully unless the company stabilizes revenue or cuts debt. The growth thesis here warrants caution. Revenue is essentially flat to declining. Earnings growth is constrained by pricing power within mature markets, and the company is in a defensive harvest mode rather than expansion mode. Investors in AT&T are buying a yield stream, not a growth engine. This dynamic is unlikely to change without significant operational transformation or industry consolidation. Now let's talk smart money. What institutional capital is actually doing with this name? 16 top-tier value-focused investors and super-investors currently hold AT&T stock. This is a meaningful base of fundamental capital. Among these holders are Ariel Investments, which holds AT&T at 0.32% of its portfolio and is marked as a buyer, and Mares and Power Funds, which holds the position at 0.0% of portfolio with no change. The presence of quality value investors suggests some institutional capital views AT&T as a deep value opportunity, though the small portfolio weighting suggests none are making a concentrated bet. On the institutional side, 14.9% of 13F filing investors, meaning institutions required to publicly report equity holdings above a threshold, are net buyers of AT&T stock. For context, above 50% would indicate a broad institutional consensus to accumulate. At 14.9%, this signals mixed sentiment among institutional capital. The data does not indicate a stampede into the name. Insider ownership is extremely low at 0.17%. Management has very little skin in the game. Over the trailing 3 months, there have been 0 insider purchases and 0 insider sales. This inactivity is notable. It suggests management views the current valuation as neither compelling nor distressed, or alternatively, that insiders are operating under trading restrictions. The smart money picture is cautious. Value investors own AT&T for yield and valuation, but they are not aggressively accumulating. Institutional appetite is mixed. Management has no meaningful equity stake, which creates a misalignment of interests between executives and shareholders. In our view, the smart money narrative does not provide strong bullish conviction. And finally, the verdict. Let's bring it all together. On valuation, the stock trades at an attractive PE multiple of 8.69 times, yet the GuruFocus intrinsic value model suggests the market is pricing AT&T at a 22.79% premium. Valuation is mixed, cheap on earnings but full on fundamentals. On financial strength, the balance sheet is leveraged with heavy debt, tight liquidity, and bankruptcy risk model show distress signals. The Altman Z score at 0.98 is below safe thresholds. This is a material constraint that limits flexibility. On profitability, AT&T generates healthy margins and substantial free cash flow, but return on invested capital of 5.7% sits below the cost of capital. The company is profitable but not creating economic value. On growth, revenue is declining or flat, earnings growth is constrained, and the business is in harvest mode. Growth is the weakest dimension. On smart money, value investors own AT&T, but institutional appetite is mixed and insider ownership is negligible. Management alignment with shareholders is poor. The overall setup is this. AT&T is a mature, stable utility-like telecom with attractive yield, cheap earnings multiples, and solid cash flow. But the company faces structural headwinds, a highly leveraged balance sheet, minimal growth, and limited insider conviction. In our view, this is a yield play for income investors with high risk tolerance, not a compounding growth investment. The setup warrants caution given the financial constraints and secular headwinds. One might argue the valuation supports a position at current levels, but the bear case rests on continued debt pressure, limiting flexibility, and revenue headwinds accelerating. Everything in this video is our interpretation of publicly available data, not financial advice. Please consult a licensed financial advisor before making any investment decisions. That's the deep dive on AT&T Inc. Like and subscribe so we can keep providing you with no-nonsense, data-driven analysis of stocks. We will keep updating our videos as soon as new data that affects the stock becomes available.